Hello everyone, this is Andrew McNair from SWAN Capital with our July 2022 SWAN Report. In this month's video, we're going to discuss some recent headlines that have influenced the financial markets over the last month. And I want to provide you some perspective on what these developments may mean for you over the next few months ahead. Now, as always, please stay tuned at the end of this video for some required disclosure statements. Now, it might not be a surprise, but at SWAN Capital, our market outlook remains cautious because of inflation as well as the rising interest rate environment and its effect that it's had on the market, creating a lot of unwanted volatility. Now, markets have headed the wrong direction pretty much this entire month over increased worries with the Federal Reserve's inflation battle that continues to persist, and the fears that it would push the U.S. into a deep recession. Now, the concern has spiked after Fed Chair Jerome Powell said that he was more concerned about the risk of failing to stamp out high inflation than he was about the possibility of raising interest rates too high and pushing the economy into a recession. Obviously, investors and analysts don't like to hear that. They want to be coddled and they want a very easy market to trade within. It seems like Chairman Powell is no longer concentrating on bringing us into a soft landing and instead put the Fed's full energy behind bringing down inflation rates, which is comforting. It's just sadly a little too late. Economic data also pushed markets down as much of the data missed the consensus expectations, and some signals suggested actually economic activity may be slowing. Personal consumption expenditures indicated consumers are starting to pull back on their spending habits and their behavior of overspending in the past. While the consumer confidence index came in significantly lower than anticipated, and consumer sentiment, which weighs basically Americans' moods and is often used as an economic indicator, fell to its lowest point on record recently. So we're keeping a close eye on consumer confidence. After experiencing robust growth in 2021, the U.S. economy began to falter in the first half of 2022. We saw that GDP posted a 5.7% annual growth rate in 2021, but it's contracted by 1.5% in the first quarter of 2022. So why the shift? One significant contributor is consumers, who make up 70% of economic activity, have been feeling the financial pinch as these rising prices on everything from gas to groceries are taking bigger and bigger bites out of their budget. Now, remember that we need a robust GDP to dig us out of the hole of the COVID recession that we fell into shortly after 2020. Now, meanwhile, households are no longer receiving stimulus payments or advanced child tax credit payments. And as a result, many Americans are increasingly dipping into their savings and paying for essentials scary with credit cards. The personal savings rate, or how much each person saves as a percentage of income, spiked to 26% in 2021 in conjunction with the third stimulus payment. But by April 2022, that savings rate had plummeted to 4.4%. So how quickly our behavior has changed when free money dries up. The Chicago Federal Reserve also reported its gauge of national economic activity had reached an 8-month low, while June's manufacturing activity came in well below forecasts. So that may sound like bad news, but traders actually welcomed the data because it also showed that the prices manufacturing companies actually are charging had reached its lowest level in over a year. So the major catalyst for improvement is economic data, which offered several signals that the Federal Reserve's monetary tightening actions are starting to actually have an effect on inflation, which is great news. The National Association of Realtors reported that May existing home sales actually fell to their lowest level in 2 years. So you're seeing refinance rates come to a screeching halt. You're seeing new home purchases starting to slow down. And basically, the group's chief economist actually predicted further decline ahead as mortgage rates are probably going to continue to climb. So half the year is already in the books for 2022, and the correction in the market is offering many opportunities for investments. So at SWAN Capital, we have been proactively managing our clients' accounts by rebalancing and investing in cash and transitioning bonds into more equities, as well as processing your Roth conversions. We are taking actions on the behalf of our clients so they can enjoy all the benefits of a recovery when it finally happens. Now, it may be 12 to 18 months ahead, but this is the time to take action, take that lazy money off the couch and put it into your portfolio and into the market. However, we always stay ready for future downturns because bear markets can last for months, and having a plan in place is the best way that we know how to stay ahead of the market and make the best decisions for our client families. Now, that's going to be it for this month's SWAN Report, and I want to thank you for listening every month to our SWAN Report. Now, remember that this is not personal financial advice to you, and how could it be? Because many people are listening. But if you do have questions about your personal financial situation, please give us a call at 1-800-848-8768. That's 1-800-848-8768, and we'll be happy to talk to you personally one-on-one. Have a great month.